Hello friends, today's topic is other investment contribution linked tax incentive which are covered under section 35. In this topic, we will be studying what is the investment related incentive, what is contribution related tax incentive, where contribution is made for rural development in notified agricultural project, in notified skill development project and etc. So friends, first topic in other investment related contribution related tax incentive which are covered in section 35. So first is contributions for rural development where a company donates or gives payment in notified rural development fund which is set up by the central government, which is notified by the central government. Any contribution made by the company in the previous year will be allowed as deduction to the SSC. There are two funds. First is Notified Rural Fund, which we have as discussed. It should be set up and notified by the central government. And second is Notified National Urban Poverty Eradication Fund. Again, it should be set up and notified by the central government. If yes, then any contribution to both of this fund, to any of this fund, will be eligible for 100% deduction, and any deduction allowed in the previous year or in the provision of 35 CCA won't be allowed in any of the provisions of the Income Tax Act or in any of the subsequent previous year. So on your screen, contributions for rural development, section 35 CCA, deduction of the following payment or contribution made by the SSC is allowed during the previous year. First, Notified Rural Development Fund. Payment to a rural development fund set up and notified by central government. Till date, National Fund for Rural Development has been notified for this purpose by the central government. Second is Notified National Urban Poverty Eradication Fund. Again, this should be set up and notified by central government. And to avoid double deduction, deduction if allowed under this section, no deduction in respect of the same expenditure can again be claimed by the SSC. Now the next provision is expenditure on agricultural extension project. In this section, which is 35CCC, the SSC should initiate a notified agricultural extension project, which should be related to farmers, to train them, to educate them, and it should be above the capital expenditure should be more than the specified limit, excluding cost of land and building. It should be for the benefit of the farmers. The agricultural extension project should be notified by CBDT, Central Board of Direct Taxes. In such notified project only the SEC should be investing, and any deduction in such a project, in agricultural extension project, is eligible for 150% deduction in the hands of the SSC. It is eligible for a weighted deduction in the hands of the SSC. And from assessment year 21-22, that is financial year previous year 2021, the deduction is allowed at 100%. So basically, all the provisions that we have studied till date, in whichever provisions the weighted deduction was allowed to the SSC of 150%, in that from previous year 2021 or assessment year 21-22, the weighted deduction has been reduced to a standard deduction which is 100%. So expenditure on agricultural extension project on the screen. It is covered in Section 35CCC, Subsection 1, where an SSC incurs any expenditure on agricultural extension project notified by the board. So it should be notified by the board. Board herein is Central Board of Direct Taxes, CBDT, notified by the board in this behalf in accordance with guidelines as may be prescribed. Then there shall be allowed a deduction of sum equal to 1 and 1/2 times of such expenditure, provided that for the assessment year beginning on or after first day of April 21, the provisions of this subsection shall have effect as if the words a sum equal to 1 and 1/2 times of the words a sum equal to had been substituted. So sum equal to means the amount contributed, the amount paid as expenditure will be allowed as 100% instead of 150% from assessment year 21-22. Subsection 2, where a deduction under this section is claimed and allowed for any assessment year in respect of any expenditure referred to in subsection 1, deduction shall not be allowed in respect of such expenditure under any other provisions of the Act for the same or any other assessment year. Again, a provision, a subsection is being inserted wherein to avoid double deduction, such deduction won't be allowed in any other provisions, of the Act or in any other assessment year to the same SSC. Now, what are the guidelines for approval of agricultural extension project under section 35CCC? And what should be the criteria? Criteria in a way we discussed that it should be for the benefit of the farmers. There is a prescribed limit for investment in the capital expenditure for investment in the project. Apart from cost of land and building, there should be a capital investment of more than 25 lakhs, and it should be approved by the Ministry of Agriculture. It should be an approved project. So this comes from Rule 6AAD, wherein guidelines has been prescribed for taking approval of agricultural extension project by the SSC, and it's only when the project is approved then only the SSC will be eligible for deduction. On your screen, Rule 6AAD, guidelines for approval of agricultural extension project under section 35CCC. First of all, project must be notified. The agricultural extension project eligible for this weighted deduction shall be notified by CBDT. First condition, the project shall be considered for notification if it fulfills all the following conditions, namely, so all the following conditions should be satisfied, then only it will be notified by CBDT. First, the project should be for the benefit of farmers. The project shall be undertaken by an SSC for training, education, and guidance of farmers. So it should be for the farmers. The project shall have prior approval of the Ministry of Agriculture, Government of India. So approval of the ministry, and expenditure not being expenditure in the nature of cost of any land or building exceeding the amount of 25 lakhs is expected to be incurred in the project. So exceeding the amount of 25 lakhs should be the cost of the project. And in the subsequent paras, you will see that amount should be met by the SSC only. It should not be met directly or indirectly by any other person, or in any way if it is reimbursed to the SSC. If the cost is reimbursable to the SSC, then also on that cost which is reimbursed will not qualify for deduction under section 35CCC. All expenses not being in the nature of cost of any land or building is reduced by the amount received from beneficiary. Amount if received from any beneficiary incurred wholly and exclusively for undertaking an eligible agricultural project shall be eligible for deduction under section 35CCC, meaning any expenses incurred by the beneficiary. Ultimately, this para says, here in this para, the beneficiary term has been used, wherein amount is received from the beneficiary, or you can say farmers. So any amount received from them should be reduced from the ultimate expenditure for deduction, and the net expenditure will be allowed for deduction under section 35CCC. So the net amount will be eligible for deduction. However, expenditure incurred on the project which is reimbursed or reimbursable to the SSC by any person, whether directly or indirectly, shall not be eligible for 35CCC. Any amount which is reimbursable to SSC shall not be eligible for any deduction under section 35CCC. So friends, now the next rule, which is part of 35CCC, wherein conditions. Rule is 6AAE, conditions subject to which an agricultural extension project to be notified under section 35CCC. So the project will be notified only when, or you can say the project to be eligible for a weighted deduction, the conditions to be satisfied as per rule 6AAE are that the accounts of the SSC should be audited by chartered accountant, an audit report should be submitted by the CA, and along with the return of income of the SSC, the audit report is to be submitted. Also, a certificate from the Ministry of Agriculture, a certificate from the Ministry of Agriculture stating that the project is indeed genuine should be obtained by the SSC. So, Rule 6AAE provides additional conditions for claiming weighted deduction by the SSC. Conditions for claiming weighted deduction. Weighted deduction in respect of expenditure incurred for the notified agricultural extension project would be available if SSC maintains separate books of accounts of such agricultural extension project and gets such books of accounts audited by an accountant. So, maintain books of accounts and get it audited. Furnish the following on or before the due date of furnishing of return of income to the Commissioner of Income Tax or Director of Income Tax. So the following should be submitted. Furnish the following with the return of income. First is audited statement of accounts along with audited report, a note on agricultural project undertaken and program of extension, agricultural extension project to be undertaken during the current year and financial allocation for such program. So a brief note on the agricultural project which has been undertaken by the SSC must be submitted with return of income, and a certificate from Ministry of Agriculture regarding the genuineness of the project should be submitted with the return of income. So along with the return of income, in order to claim weighted deduction, the SSC is required to submit audited statement along with audit report, a brief note on the agricultural project undertaken, and a certificate from the Ministry of Agriculture stating the genuineness of such project. So this was the end of second provision under other investment related or contributions related tax incentive scheme. First, we have studied section 35CCA, contributions for rural development, and second is expenditure on agricultural extension project. Now friends, the third provision, which is covered in section 35CCD, expenditure on skill development project. So friends, first of all, the purpose of this skill development project. The purpose of this skill development project is to encourage private sector to chip in and to create their own institution for skill development in manufacturing sector. There should be public private partnership in developing skills, in developing national skills related to manufacturing sector. On your screen, the National Manufacturing Policy has been notified by Department of Industrial Policy and Promotion DIPP. As per the notified NMP, which is National Manufacturing Policy, the government will provide weighted standard deduction of 150% of the expenditure incurred by the SSC other than land or building incurred on public private partnership PPP project for skill development in manufacturing sector. So it will be incurred on PPP public private partnership project for skill development in the manufacturing sector, and deduction of 150% will be allowed to the SSC. The purpose being encouraging private sector to set up their own institution in coordination with National Skill Development Corporation. So friends, after understanding the basic purpose of skill development project, now what are the provisions of section 35 CCD? As per these provisions, any expenditure incurred by the company for the purpose of skill development project, which is notified by CBDT, which is notified by the board as per prescribed guidelines, then any payment to such project, any payment to such notified project will be eligible for 150% deduction, 150% weighted deduction till assessment year 2021. From previous year, from previous year 21, from previous year 2021, the weighted standard deduction will no more be allowed. A standard deduction of 100% will be allowed to the SSC, and any deduction under this section, if deducted by the SSC, then the same deduction won't be allowed in any assessment year, and the same deduction won't be allowed in any other provisions of the Income Tax Act. Also, there are conditions wherein the purpose for which the project is being notified are mentioned in rules. The conditions, the additional conditions to be satisfied, wherein the accounts of the company should be audited, the audit report should be submitted along with the return of income, So there are additional conditions which are mentioned in the rule 6 which are to be satisfied for the purpose of availing the weighted deduction, for the purpose of availing the deduction under section 35 CCD. On your screen, where a company incurs any expenditure, not land or building, on any skill development project notified by the board in this behalf in accordance with the guidelines as may be prescribed, then there shall be allowed a deduction of a sum equal to 1.5 times of such expenditure. So, not on land or building, any expenditure will be allowed apart from land and building. It should be notified by the board. If yes, then 1.5 times of such expenditure will be allowed as deduction, provided this provision is for 100% deduction, which has been changed from April 21 assessment year. Subsection 2, where a deduction under this section is claimed, then no further deduction shall be allowed to the SSC. Guidelines for approval of skill development project under section 35 CCD. What are the guidelines for getting this skill development project notified? Herein, the extract of rule 6AAF has been mentioned, which is the expenditure will be allowed to the eligible company only, and the eligible company is a company which is engaged in manufacturing of any article or thing except for few items mentioned in 11th schedule. So eligible company is manufacturing company which is into manufacturing of any article or thing except for few items mentioned in 11th schedule, and these exception items are: the manufacturer should not be involved in manufacturing other alcoholic spirits, beer, wine or other alcoholic spirits, or tobacco products. These are the exceptions. Apart from that, if SSC is into manufacturing business, then he will be a eligible company. It will be a eligible company. Also, there are certain specified services which have been mentioned which gets covered in eligible company. There is a list of 29 services which has been mentioned under Rule 6, wherein the companies will be stated as eligible company for the purpose of reduction under Section 35 CCD. So the skill development project is available to a eligible company, and it should be undertaken. The project should be undertaken in a training facilities. Sub-rule 1, a skill development project shall be considered for notification if it is undertaken by an eligible company and the project is undertaken in separate facilities in a training institute. It will be available to eligible company only, and the project should be undertaken in a training institute as per Rule 6AAF, and herein only sub-rule 1 has been mentioned, only relevant extract has been mentioned over here. Further, additional conditions subject to which a skill development project is to be notified. So additional conditions are, as stated earlier, the books of accounts. The SSC has to maintain books of accounts. He has to get the books of accounts audited by a chartered accountant. The audit report will have to be submitted along with the return of income to Commissioner of Income Tax or Director General of Income Tax. Further, there is an additional provision over here wherein the existing employees, training to the existing employees of the SSC who are in the system, who are with the company for more than 6 months. To such employees, providing training won't be eligible for skill development project only if the employee is for the less month than 6 months. Only if the employee is with the company for less than 6 months, and any skill development training provided to such employees by the SSC will be eligible. So on your screen, sub-rule 1 of Rule 6AAG, a company undertaking skill development project shall maintain separate books of accounts of the skill development project notified under subsection 1 of section 35 CCD and get such books of accounts audited by an accountant as defined in explanation below subsection 2 of section 28. So maintain separate books of accounts, get books of accounts audited. First condition. Sub-rule 3, a skill development project in respect of existing employees of the company shall not be eligible for notification under subsection 1 of 35 CCD where the training of such employees commences after 6 months of their recruitment. So, after 6 months, any training provided to the employee won't be eligible for any deduction under section 35 CCD. So, to existing employees, it's skill development training. Sub-rule 4, all expenses not being in the nature of cost of any land or building incurred wholly and exclusively for undertaking a notified skill development project shall be eligible for deduction under section 35 CCD. Apart from above, any expenses incurred which is related to skill development project shall be eligible for deduction. Provided, again reimbursement, this proviso talks about the reimbursement. If any amount has been reimbursed to the SSC in any way, directly or indirectly, then such amount won't be eligible for any deduction. that any expenditure incurred on the skill development project which is reimbursed or reimbursable to the company by any person, whether directly or indirectly, shall not be eligible for reduction. Under section 35 CCD, the company shall honor before the due date of furnishing the return of income under subsection 1 of section 139 furnish the audited statement of accounts of the skill development project for the previous year along with the audit report. So, along with the return of income, audited statement, audit report should be submitted to the Commissioner of Income Tax or Director of Income Tax as the case may be. So these are the additional conditions mentioned under Rule 6AA-G. Further, the reduction as per Rule 6AA-F, reduction is available to an eligible company only. The definition of the same that we have discussed earlier has been mentioned in Rule 6AA-H. For the purpose of Rule 6AA-F and 6AA-G, eligible company means a company which is engaged in the business of manufacture or production of any article or thing, not being an article or thing mentioned at the serial number 1 and serial number 2 of the list of articles specified in 11th schedule. So those items are tobacco products and alcoholic spirits. In bracket, the same has been mentioned, a company engaged in the business of manufacture or production of any article or thing, not being beer, wine, and other alcoholic spirits and tobacco preparations, or engaged in providing specified services, or eligible company can also be engaged in providing specified services which are mentioned in rule. A list of 29 services has been mentioned in rule 6AA-H. So friends, deduction under section 35 CCD is available to a company when the expenditure is made in a notified skill development project, and the company should be an eligible company as per rule 6AA-H. Accordingly, a weighted deduction of 150% will be allowed till assessment year 2021, and after assessment year 2021, the deduction will be 100% of the expenditure incurred by the eligible company. Now friends, the next topic is amortization of certain preliminary expenses, which is covered in section 35D. Under this section, the expenditure incurred before the commencement of the business by a new unit, or expenditure incurred by the existing company on extension of a new setup. So any expenditure before commencement of such a business will be allowed as deduction in 1/5 of installments to the company, and the eligible company or the eligible entity in this regard is an Indian company or an Indian resident. So it is only allowed to the residents of India. In a way, you can say that it is only allowed to residents of India, and the expenditure which is incurred before commencement of the business will be allowed to the SSC in 1/5 of installments or 20% of the expenditure. Also, the expenditure which is allowed will be 5% of the cost of the project, 5% of the cost of the project, or capital employed by the SSC, whichever is less. So cost of the project or capital employed by the SSC, whichever is less, 5% of that will be the expenditure will be allowed as preliminary expenses, and it will be allowed in 20% of installment to the SSC. And friends, also the preliminary expenses. What are the nature of expenses which is allowed to the SSC? So before a company comes into existence, the fees, the legal fees related to registration of the company, legal fees for drafting memorandum of association, articles of association, those expenses will be allowed to the company because it has been incurred before commencement of expenses, before commencement of the business, Also, if there is any public issue where there is a public subscription which the company is coming up with, and if any legal charges related to it are paid by the company, that expenses also will be allowed as preliminary expenses to the company, also to other entities, which is applicable even to company. Any expenses on feasibility report, project report, expenses on market survey, expenses, legal expenses on drafting an agreement by the company with any other person, which is before setting up of the company, those expenses will be allowed to the SSE under section 35D in installments. On your screen, subsection 1 of section 35D, wherein SSE, being an Indian company or a person other than a company who is resident in India, incurs after 31st of March 1970 any expenditure specified in subsection 2. So the nature is specified in subsection 2, and the expenditure is allowed to an Indian company or person who is resident in India. The expenditure allowed will be before the commencement of his business or after the commencement of his business, in connection with extension of his undertaking or in connection with his setting up of a new unit. So expenses after commencement of business will be eligible for an existing company who is setting up an extension of the undertaking or setting up a new unit. If above conditions are satisfied, the SSC shall, in accordance with and subject to the provisions of this section, be allowed a deduction of an amount equal to 1/10. Previously it was 1/10, now it has been changed to 1/5 of such expenditure for each of the 10 successive previous year. Now it is 5 successive previous year, beginning with the previous year in which business commences, or as the case may be, the previous year in which the extension of the undertaking is completed or the new unit commences production or operation. So in the first year itself, the expenses can be claimed as deduction, and thereafter in 4 preceding years, immediate preceding years, the deduction will be available. And in this proviso, the deduction of 1/5 has been mentioned, provided that when an SSC incurs after 31st of March 1998 any expenditure specified, the nature which is specified in nature of expenditure which is specified in subsection 2, the provisions of this subsection shall have effect as if for the words an amount equal to 1/10 of such expenditure for each of the 10 successive previous years, the words will be an amount equal to 1/5 of such expenditure for each of 5 successive previous year has been substituted. So the deduction from the year 1998, any expenditure after 1998 will be eligible on 1/5, which is 20% of the total expenditure in 5 successive previous years. Now, subsection 2 will specify the nature of the expenditure. The expenditure referred to in subsection 1 shall be expenditure specified in any one or more of the following clauses, namely, so the expenses should fall in the below category: expenditure in connection with preparation of feasibility report, preparation of project report, conducting market survey or any other survey necessary for the business of the SSC, engineering services relating to the business of the SSC, provided above expenses, provided that the work in connection with the preparation of feasibility report, project report, market survey, engineering services referred to above is carried out by the SSC himself. The above should be carried out by the SSC himself or by a concern which is approved by the board, or by a concern which is approved by CBDT. So above expenses should be carried out by the SSC himself or by any concern, any entity which is approved by the board. Then only above expenses will qualify for preliminary expenses. Legal charges for drafting any agreement between the SSC and any other person for any purpose relating to the setting up or conduct of the business of the SSC. Legal charges for drafting an agreement will be termed as preliminary expenses eligible for deduction under Section 35D, Clause C, where the SSC is a company. Also, expenditure, below mentioned expenditure will be eligible, which is nothing but memorandum, articles of association, fees for registration of the company, public issue expenses, by way of legal charges for drafting the memorandum and articles of association of the company, on printing of the MOA and AOA, fees for registering the company under the provisions of Companies Act 1956 or 2003, 2013, in connection with the issue for public subscription of shares or debentures of the company, being underwriting commission, brokerage, and charges for drafting, typing, printing, and advertisement of prospectus. So specific expenses related to public subscription has also been mentioned under subclause 4 of clause C of subsection 2 of section 35D. And clause D, such other items of expenditure not being expenditure eligible for allowance or deduction under any other provisions of the Act as may be prescribed. Until date, nothing has been prescribed. So there is a scope in clause D wherein such other items of expenditure which is prescribed will also be allowed. However, till date nothing has been prescribed. So we will have the expenses incurred which are mentioned in clause A, B and C, and only for this specified expenses will be termed as preliminary expenses for the purpose of deduction under section 35D. Subsection 3 states the quantum of deduction available to the SSC where the aggregate amount of the expenditure referred to in subsection 2 exceeds an amount calculated at 2.5%, which is 2.5%, which has been changed to 5% of the cost of the project, or in the case of Indian company, at the option of the company, capital employed in the business of the company. So capital employed and cost of the project, these two are the expenditure. Any expenditure in excess of 5% of cost of project or capital employed will be ignored for the purpose of reduction under section 35 AD. So 35D, not AD. Excess shall be ignored for the purpose of computing the reduction allowable under subsection 1. So 5% of the cost of the project or capital employed will be compared with the aggregate amount of expenditure which has been incurred by the SSC. Provided from March 1998, it has been changed to 5%, and where the aggregate amount of expenditure referred to in subsection 2 is incurred after 31st day of March 1998, the provisions of this subsection shall have effect as if for the words 2.5%, the words 5% has been substituted. Now, in the explanation to subsection 3, the meaning of the cost of the project has been specified, the meaning of the capital employed has been specified, and meaning of the long-term borrowing which is part of capital employed. Capital employed includes issued share capital, long-term borrowing to the SSC, and includes debentures. So three items are included in capital employed of the business of the SSC: issued share capital, debentures, and long-term borrowings. As per the explanation to subsection 3, definition of three terms have been provided: cost of the land, capital employed, and long-term borrowings. Cost of the land is nothing but the tangible assets, the total of the tangible assets which has been held by the SSC. So friends, on your screen, explanation: cost of the project means clause 1. In a case referred to in clause 1 of subsection 1, the actual cost of fixed of assets. The actual cost of fixed assets being land, building, leasehold plant machinery, furniture fittings and railway sidings, including expenditure on development of land and buildings, including expenditure on development of land and buildings, which are shown in the books of accounts of the SSC as on the last day of the previous year in which the business of the SSC commences. So tangible assets including land and building, which are shown in the books of accounts as on the last day of the previous year. Last day of the previous year in which the business of the SSC commences. Any tangible assets which are reported in the books of accounts will be considered for the purpose of cost of project, clause 2, in a case referred to in clause 2 of subsection 1. So in a case referred to in clause 2 of subsection 1 is nothing but expenditure incurred by the existing company on setting up a new unit, on venturing into a new unit, and clause 1 of cost of the project was related to altogether a new company. So actual cost of such existing company will be fixed assets being tangible assets including land and building, which are shown in the books of the SSC on the last day of the previous year in which the extension of the undertaking is completed. Last day of the previous year in which extension of the undertaking is completed, or as the case may be, the new unit commences production or commences operation. In that previous year, the last day will be considered for the cost of the project insofar as such fixed assets has been acquired or developed in connection with the extension of the undertaking or setting up of a new unit. So it should be related to the extension of the project, extension of the new unit. I mean, there should be a connection. The tangible assets mentioned as part of cost of the project for the purpose of deduction under section 35D, such tangible assets should have connection with the extension of the new unit. Either it should be acquired by the new unit or should be developed by the new unit. Now, capital employed in the business of the company means in a case referred to in clause 1, which is altogether a new company as per subsection 1, the aggregate of issued capital, debentures and long-term borrowings. As we had discussed earlier, three items are included, three components are part of capital employed as per this provision, which is issued share capital, debentures and long-term borrowings as on the last day of the previous year in which the business is commenced. For extension of the new unit, for that purpose, it will be aggregate of issued share capital, debentures and long-term borrowings. The definition remains the same. And last day of the previous year in which extension of the undertaking is completed or new unit commences production or operation, and such capital employed should be related, should be connected with extension of the undertaking or setting up of a new unit. Now long-term borrowings means any monies borrowed by the company from government or IFC of India, Industrial Finance Corporation or Industrial Credit and Investment Corporation of India or any other financial institution which is eligible for deduction under clause 8 of subsection 1 of section 36, or any other banking institution. Basically it could be from government, from IFC or Industrial Credit and Investment Corporation of India or any other financial institution or any other banking institution. So it has a vast coverage. Any loan taken, any long-term borrowings from such institution, and the period of payment as per clause 2 should be more than 7 years. The loan should be provided for more than 7 years. Any monies borrowed or debt incurred by it in a foreign country in respect of purchase outside India of capital, plant and machinery, whether terms under which such monies are borrowed or the debt is incurred provide for repayment thereof for a period of not less than 7 years. So the period of 7 years is eligible for monies borrowed or debt incurred in a foreign country in respect of purchases which are made outside India of tangible assets, where the repayment terms should be not less than 7 years. Now friends, subsection 4, wherein deduction will be available to an entity, to a person other than company or cooperative society, only if they maintain a separate books of accounts and get those books of accounts audited by an accountant. And the audit report is required to be submitted along with the return of income for the purpose of deduction under section 35D. Subsection 5 and subsection 5A are related to amalgamation and demerger, wherein before the expiry of 5 years, if the asset is transferred in the scheme of amalgamation or demerger, then the provisions which are applicable to the amalgamating company, to company A, will continue to apply to the amalgamated Indian company, which is company B. Similarly, it applies for demerger as well, wherein the demerged company won't be eligible from the date of transfer of assets, won't be eligible for deduction, and the eligibility will be transferred to the resultant company from the date of transfer of the assets. On your screen, subsection 4, where the SSC is a person other than a company or a cooperative society, no deduction shall be admissible under subsection 1 unless the accounts of the SSC for the year or years in which the expenditure specified in subsection 2 is incurred have been audited by an accountant specified in section 288, and the SSC furnishes along with the return of income for the first year in which the deduction under this section is claimed, the report of such audit, the audit report in the prescribed form, duly signed and verified by such accountant, and setting forth such particulars as may be prescribed. So, along with the return of income, the prescribed audit report is required to be submitted by the SSC for claiming deduction under section 35D. Subsection 5, related to scheme of amalgamation, where the undertaking of an Indian company which is entitled to deduction under subsection 1 is transferred, and the undertaking is transferred before the expiry of 10 years, which has been changed to 5 years, to another Indian company in the scheme of amalgamation, no deduction shall be admissible under subsection 1 in the case of amalgamating company for the previous year in which amalgamation takes place. Nothing, no deduction will be allowed to amalgamating company. The provisions of this section shall, as far as may be, apply to the amalgamated company as they would have applied to the amalgamating company if the amalgamation, considering that the amalgamation had not taken place. Basically, the eligibility for deduction under section 35AD gets transferred from amalgamating company to amalgamated company. Both the companies are Indian company, where the undertaking of an Indian company which is entitled to deduction under subsection 1 is transferred before the expiry of the period specified in subsection 1, which will be 5 years, to another company in a scheme of demerger. So an Indian company over here, but here it is mentioned as another company in a scheme of demerger. There is no specific mention of Indian company. However, the same was mentioned in the case of amalgamation, if you noticed, wherein over here it has been mentioned, but however here the demerged company should be an Indian company and resultant company is not mentioned as Indian company specifically. In that case, no deduction will be allowed to the demerged company for the previous year in which the demerger takes place. So no deduction, and the resulting company, the provisions of this section shall, as far as may be, apply to the resulting company as they would have applied to the demerged company had the demerge not taken place. So similar provisions to amalgamation. Subsection 6 is related to double deduction, wherein deduction taken under Section 35D, the same deduction won't be eligible in any other provisions of the Act. The same deduction won't be eligible in any other assessment year. Subsection 6, where a deduction under this section is claimed and allowed for any assessment year. In respect of any expenditure specified in subsection 2, the expenditure in respect of a deduction is so allowed, the expenditure in respect of which such deduction is so allowed shall not qualify for deduction under any other provisions of the Act for the same or any other assessment year. So a standard provision which is coming in each and every investment or contribution linked tax incentive scheme. So friends, in this topic we have studied expenses related to amortization of certain preliminary expenses. The nature of the preliminary expenses has been mentioned in subsection 2, wherein project report, feasibility report, memorandum of association, AOA, registration of company expenses will be eligible as preliminary expenses. The eligible entity is an Indian company or Indian resident, and the expenditure will be allowed in 20%, that is 1/5, starting from the year in which business is commenced, and it will be followed for immediately 4 succeeding previous years. Also, the expenditure will be allowed should be before the commencement of the business, and for the existing unit, it should be before commencement of the new setup, new unit. And the expenditure will be, as per subsection 3, the quantum of expenditure as per subsection 3 over here, the quantum of expenditure will be 5% of cost of project or capital employed, whichever is less, that will be compared with the aggregate expenditure incurred, whichever is lower will be allowed as deduction in the hands of the SSC. So friends, this concludes section 35D. Now friends, the other provisions under the subtopic other investment contribution linked tax incentive is section 35DD, which says amortization of expenditure in the case of amalgamation or demerger. So where there are expenses incurred by the Indian company in the scheme of amalgamation or demerger, then such Indian company will be allowed deduction under section 35DD, which will be 1/5 in the previous year in which the amalgamation or either demerger takes place, and the remaining deduction will be allowed in succeeding 4 previous years to the Indian company. On your screen, amortization of expenditure in the case of amalgamation or demerger, section 35DD, where an SSC, being an Indian company, incurs being an Indian company incurs any expenditure on or after 1st of April 1999 wholly and exclusively for the purpose of amalgamation or demerger. For the purpose of amalgamation or demerger of an undertaking, the SSC shall be allowed a deduction of an amount equal to 1/5 of such expenditure for each of the 5 successive previous year, beginning with the previous year in which the amalgamation or demerger takes place. So starting from the previous year in which the amalgamation or demerger takes place and followed by 4 succeeding previous years, and as per subsection 2, deduction allowed under this section won't be allowed as deduction under any other provisions of the Act, of the Income Tax Act. So friends, 35DD gives deduction to an Indian company where there are expenses related to amalgamation or demerger. Now, next section is section 35DDA, which is related to amortization of expenditure incurred under VRS, Voluntary Retirement Scheme. In this, any expenditure incurred by a company in any previous year which is related to VRS and it is paid to its employee during any previous year, it will be allowed as deduction to the SSC in 1/5 of the installment, which is starting from the previous year in which the payment is made and will be followed by 4 succeeding previous year. And in the case of amalgamation, in the case of scheme of amalgamation, the deduction will be continued to be available to the amalgamated company, which is company B. In the case of demerger, the deduction will be continued to be available to the resultant company. In the case of conversion, in the case of reorganization, succession of firm or proprietary concern to a company, the deduction will be continued to be available to the company. In case of conversion from private limited company to LLP, limited liability partnership, the deduction, the expenditure on amortization will be available to the LLP. Further, deduction allowed under this section won't be allowed under any other provisions of the Act. On your screen, amortization of expenditure incurred under VRS 35DDA subsection 1, wherein SSC incurs any expenditure in any previous year. So any expenditure in any previous year by way of payment of a sum to an employee in connection with his voluntary retirement in accordance with any scheme or schemes of voluntary retirement. In such a case, 1/5 of the amount so paid shall be deducted. 1/5 of the amount so paid shall be deducted in computing the profit and gains of the business for that previous year, and the balance shall be deducted in equal installments for each of the 4 immediately succeeding previous years. So 1/5 of the amount will be allowed in the previous year in which the employee voluntarily retires, and it will be followed by immediately 4 succeeding previous years. The remaining installment will be available in immediately 4 succeeding previous years to the SSC. Now subsection 2, 3, 4 and 5, as we have just discussed, in the case of amalgamation, demerger, succession of a firm sole proprietary concern to a company, or succession of a company private limited company to LLP, what will be a scenario in which part of the VRS installment is already taken by the former company or the former entity? So in that case, the remaining installments will be available to the resultant company, to the amalgamated company. Subsection 2, where the SSC, being an Indian company, is entitled to deduction under subsection 1. So the Indian company is entitled to deduction under subsection 1, and the undertaking of such Indian company entitled to the deduction under subsection 1 is transferred before the expiry of period specified in that subsection. So the period of 5 years was pending and it has been amalgamated to another Indian company in the scheme of amalgamation. In such a scenario, the provisions of this section shall, as far as may be, apply to the amalgamated company as they would have applied to the amalgamating company if the amalgamation had not taken place. Meaning, remaining deduction will be allowed to the amalgamated company, and it should be an Indian company to Indian amalgamating company going to Indian amalgamated company. So both the companies are Indian in the scheme of amalgamation. Subsection 3, Scheme of Demerger, where the undertaking of an Indian company entitled to deduction under subsection 1 is transferred before the expiry of period specified in that subsection to another company in a scheme of demerger. The provisions of this section shall, as far as may be, apply to the resultant company as they would have applied to the demerged company if the demerger had not taken place. So it will be assumed that the demerger has not taken place and the resultant company will be allowed deduction of the remaining installments of the amortization of expenses related to VRS. Subsection 4, where there has been reorganization of business whereby a firm is succeeded by a company fulfilling the conditions laid down under section 47, or a proprietary concern is succeeded by a company fulfilling the conditions laid down in section 47, the provisions of this section shall, as far as may be, apply to the successor company as they would have applied to the firm or proprietary concern if organization of business had not taken place. Similarly, expenses remaining installments will be allowed to the successor. 4A, where there has been reorganization of business whereby a private company or unlisted public company is succeeded by LLP fulfilling the conditions laid down in section 47, the provisions of this section shall, as far as may be, apply to the successor LLP as they would have applied to the private company or unlisted public company. So similar provisions. So it will be assumed that no succession has taken place and accordingly LLP will be allowed deduction of the remaining installments. Subsection 5, no deduction shall be allowed in respect of expenditure mentioned in subsection 1 in the case of amalgamating company, demerged company, firm or proprietary concern, or the private company. In the case of respective subsections for the previous year in which the amalgamation, succession, demerger as the case may be takes place. So if the remaining installments is allowed to the amalgamated resultant successor company or successor LLP, then the deduction obviously will not be allowed to company A or amalgamating demerged firm proprietary concern or the private limited company. Won't be allowed, the remaining installments won't be allowed in their hands because the remaining installments are already allowed to the respective company. So section 5, it's just a sort of clarification which has been provided by the legislature through these provisions just to avoid double deduction. And again, subsection 6 is again to avoid a double deduction in the hands of the SSC, whereas no deduction shall be allowed in respect of expenditure mentioned in subsection 1 under any other provisions of the Income Tax Act. So friends, amortization of expenditure incurred under voluntary retirement scheme will be allowed to the SSC in any previous year in which the payment of VRS is made to an employee, and it will be allowed in 5 equal annual installments. And subsection 2, 3, 4, 4A, in the case of amalgamation, demerger, reorganization, succession of company by LLP, the remaining installments will be allowed to the resultant amalgamating successor company or successor LLP as per the provisions of Section 35 DDA. Now friends, Section 35E, wherein any expenditure incurred by the SSC for prospecting, exploring, or production of certain minerals will be allowed to the SSC under Section 35E. Here, the expenditure incurred will be in the nature of exploring the mineral mine, exploring the deposit of mine, and the period which shall be considered for the purpose of deduction is the current previous year in which commercial production of the mineral begins and previous 4 immediately preceding years. Expenditure incurred during such a period will be allowed as deduction to the SSC. So the period is the current previous year in which commercial production starts and previous year immediately 4 preceding previous years is the period during which the deduction to the SSC will be allowed under Section 35E, and the deduction will be allowed to an Indian company or a resident in India, a person who is resident in India or an Indian company. The deduction will be allowed to such SSC in 1/10 of the installments. So any expenditure incurred, the period is previous year and immediately preceding 4 years. This is the period, and the deduction will be allowed in 1/10 of the installments. That is 10% beginning with the previous year in which the commercial production begins. The amount of deduction will be 1/10 of the expenditure or the income during the previous year. Whichever is less will be allowed as deduction to the SSC. Also, there are certain expenditure which are not allowed. For example, acquisition of the site. Any acquisition cost of the site won't be allowed. Any acquisition cost of the deposit mine won't be allowed. Any capital asset, any acquisition of tangible capital asset on which depreciation is admissible, then deduction of such expenditure is not allowed. And lastly, any amount received by the SSC in the form of sale, salvage, insurance that will be deducted from the total expenditure. So friends, on your screen, deduction for expenditure on prospecting, etc. for certain minerals, Section 35E, Subsection 1, where an SSC, being an Indian company or a person other than company who is resident in India, is engaged in any operations relating to prospecting for extraction or production of any minerals and incurs after the 31st day of March 1970 any expenditure specified in subsection 2, the SSC shall, in accordance with and subject to the provisions of this section, be allowed in each one of the relevant previous year a deduction of an amount equal to 1/10 of the amount of such expenditure. So the deduction allowed is 1/10. It is allowed for prospecting, extraction, production of any mineral, and the expenditure specified is subsection 2, which not only includes what are the expenses eligible but also states what are the expenditure which won't be allowed to the SSC. Subsection 1 says SSC should be an Indian company, it should be Indian resident, income should be from activity should be prospecting, extraction, production of any mineral, and deduction will be allowed in 1/10 of the installment. Subsection 2. The expenditure referred to in subsection 1 is that incurred by the SSC after the date specified in that subsection, which is 1970, at any time during the year of commercial production. So, expenditure incurred at any time during the year of commercial production and any one or more of the four immediately preceding that year. As we have discussed, the period is concerned relevant previous year in which the commercial production begins and immediately for preceding year, wholly and exclusively on any operations relating to prospecting for any mineral or group of associated minerals specified in Part A or Part B respectively of the 7th schedule, or on the development of a mine or other natural deposit of such mineral or group of associated minerals. So here, which has been highlighted, the portion currently highlighted, it should be expenditure should be related to wholly and exclusively on the operations related to mineral, provided that there shall be excluded from such expenditure any portion thereof which is met directly or indirectly by any other person or any authority, and so expenditure met directly or indirectly by any other person or authority won't be included in the total expenditure, and any sale, salvage, compensation or insurance monies realized by the SSC in respect of any property or rights brought into existence as a result of the expenditure. So any benefit received, any amount received by the SSC will be deducted from the total expenditure. Subsection 3, it states what should not be included in the total expenditure. First, acquisition of the site of the source of any mineral or group of associated minerals referred to in subsection 2, or of any rights in or over such site. So any acquisition cost of the site of the source, any acquisition of the deposits of such mineral or group of associated minerals, or of any rights in or over such deposits. So acquisition of the deposits, acquisition of the mineral deposits. Capital nature expenditure in respect of any building, machinery, plant or furniture for which allowance by way of depreciation is admissible under section 32. So where you are claiming benefit of depreciation, you cannot be allowed deduction under any provisions of the act. So if the depreciation is admissible for such tangible assets, nothing will be allowed in the terms of acquisition cost of the capital nature of intangibles of the tangible assets, which is building, machinery, plant or furniture. Above expenses shall any expenditure which has been mentioned in clause 1, 2 and 3 shall not be deemed to be expenditure incurred by the SSC for any of the purposes specified in subsection 2. So these are excluded. Subsection 4, the deduction to be allowed under subsection 1 for any previous year shall be, so the amount of deduction has been specified in subsection 4, which as discussed earlier is 1/10 or 1/10 of the total expenditure or income earned by the SSC during the relevant previous year, whichever is less. And income will be from commercial production of the site or deposit of mineral. Clause A, amount of deduction is an amount equal to 1/10 of the expenditure specified in subsection 2, such 1/10 being hereafter in this subsection referred to as the installment. 1/10 of the expenditure. Clause B, such amount as is sufficient to reduce nil income is computed before deduction under this section. So any income which is earned in the previous year arising from the commercial exploitation. Income in the previous year arising from the commercial exploitation, whether or not such commercial exploitation is a result of operations or development referred to in subsection 2. In this clause, the commercial exploitation is not only related to the previous year, but it could be related to earlier year as well, as a result of which you are now, as a result of operations in the earlier previous year, you are now able to do commercial production. So it is not limited to the current previous year, but also to the preceding previous years as a result of the operations taken earlier in the earlier previous year. Now you are able to commercially exploit the site, commercially exploit the mine. So income of the previous year arising from the commercial exploitation of any mine or other natural deposit of the mineral, or any one or more of the minerals in the group of associated minerals as aforesaid, in respect of which expenditure was incurred. So clause B means to say that any income arising from the commercial exploitation of any mine, and one tenth of the expenditure which has been stated in clause A will be compared, whichever is less will be allowed as deduction as per subsection 4, and any amount remaining unutilized, any amount of one tenth of the expenditure which is unabsorbed, in such a case it will be carried forward to the next previous year for the purpose of set off, and it can be carried forward for the next 9 succeeding previous years. So one tenth is 10%. If 10% cannot be utilized in the current previous year, then it will be carried forward to the next previous year for the purpose of adjustment against the income in the succeeding 9 previous years. So the validity of the loss which can be carried forward is up to 9 succeeding previous years only, and not exceeding that. So proviso says relating to carry forward and set off of unabsorbed one tenth of the expenditure, provided that the amount of installment relating to any relevant previous year, to the extent to which it remains unallowed, to the extent to which it remains unallowed, which is unabsorbed, shall be carried forward and added to the installment relating to the previous year next following, and deemed to be part of that installment, meaning it will be carried forward and will be part of the next installment, immediately succeeding installment, and so on for succeeding previous years. So, however, that no part of any installment shall be carried forward beyond 10th previous year is reckoned from the year of commercial production. So it cannot go beyond the 10th previous year, meaning the carry forward of the installment is allowed only up to the 10th previous year. Anything beyond that won't be allowed to carry forward and set off. So subsection 4 stated about the amount of deduction. Subsection 3 stated the exclusion of expenditure, the expenditure which won't be allowed as deduction in the hands of the SSC. Subsection 1 stated the eligibility of the company who are eligible. Then what are the activities from which the income will be considered for deduction, the expenditure will be considered for deduction, and one tenth of the expenditure will be allowed to the SSC is mentioned in subsection 1. And subsection 2 stated the activity from which the expenditure will be allowed to the SSC, which is nothing but commercial production from extraction, prospecting, or production of mineral oil will be considered for the purpose of deduction under section 35E. So subsection 1, 2, 3 and 4 we have already covered. Subsection 5 states the definition of the terms which has been used in the preceding subsections. So the first is operations relating to prospecting, means any operation undertaken for the purpose of exploring, locating or proving deposits of any mineral. Any operation undertaken for the purpose of exploring, locating, proving deposits of any mineral, and includes any such operation which proves to be infructuous or abortive. So meaning, going by the nature of the extraction of mineral, first you have to, you know, dig deep into the mineral site in the mineral deposit to understand whether there is any mineral or not in the particular site which has been purchased, in the mineral deposit which has been purchased. So first the company has to determine whether there is any mineral or not in the site, in the deposit mine. It could be that it has found a mineral in the site, in the land, or it could be that no minerals are found in the process of extraction. So it could be successful, as well as there could be a possibility that no mineral is found at all. So accordingly, the sentence which I have highlighted now is for the activities where the operations undertaken to determine whether there is any mineral or not, and such an operation also includes operation wherein which proves infructuous or abortive, wherein you have not found any mineral deposit in the operation. So it includes the unsuccessful operations as well under the definition of operation relating to prospecting, and accordingly successful or unsuccessful, both the operations will be considered for the purpose of deduction. Year of commercial production means the previous year in which, as a result of any operation, the previous year in which, as a result of any operation relating to prospecting, commercial production of any mineral or any one or more of the minerals in the group of associated minerals specified in the seventh schedule commences. So basically, the activity of prospecting, commercial production, extraction commences is the year of commercial production. Relevant previous year means the 10 previous years beginning with the year of commercial production. Now friends, subsection 6, 7, 7a and 8, these are the remaining subsections. So subsection 6 says, for the purpose of deduction, for the purpose of to be eligible for the deduction under section 35e, a person other than a company or cooperative society, will have to maintain books of accounts, will have to audit such books of accounts, will be eligible for audit. Such books of accounts should be audited by a chartered accountant, and the audit report should be submitted along with the return of income of the SSC. So a person other than a company or cooperative society will have to maintain books of accounts. Those books of accounts are required to be audited by a chartered accountant, and the audit report will have to be submitted along with the return of income of the SSC as per subsection 6. Subsection 7 and 7a. Subsection 7 is related to amalgamation. In the case of amalgamation, nothing will be allowed to the amalgamating company from the year of amalgamation. It will be allowed to the Indian Amalgamated Company, and provisions which were applicable to amalgamating company will continue to be applied to the amalgamated company. And in the scheme of demerger, which is mentioned under subsection 7a, provisions applicable to demerged company will continue to apply to resulting company, and the remaining installments of the expenditure will be allowed to the resultant company. Subsection 8 says no deduction will be allowed in or under any provisions of the Act, under any other provisions of the Income Tax Act, if deduction under this section has been allowed to the SSC. So on your screen, subsection 6, where the SSC is a person other than a company or cooperative society. So a person other than a company or cooperative society, no deduction shall be admissible under subsection 1 unless the accounts of the SSC for the year or years in which expenditure specified in subsection 2 is incurred have been audited an accountant as defined in section 288, and the SSC furnishes along with his return of income for the first year in which the deduction under this section is claimed. So in the first year in which the deduction under this section is claimed, the report of such audit in the prescribed form duly signed and verified by such accountant and setting forth such particulars as may be prescribed. So basically, books of accounts should be audited and along with the return of income furnishes such audit report, such signed audit report in the first year of deduction. So in the first year of deduction, the SSC other than a company or cooperative society will be required to submit the report along with the return of income. Subsection 7 related to amalgamation, that the undertaking of an Indian company which is entitled to deduction is transferred before the expiry of period of 10 years specified to another Indian company in a scheme of amalgamation, no deduction shall be admissible under subsection 1 in the case of amalgamating company for the previous year in which the amalgamation takes place, since deduction is allowed to amalgamated company. Accordingly, amalgamating company will no more be allowed deduction. So no deduction to amalgamating company. The provisions of this section shall, as far as may be, apply to the amalgamated company as they would have applied to the amalgamating company, considering that amalgamation had not taken place. So, provisions of this Act will continue to apply to amalgamated company. Subsection 7A, where the undertaking of an Indian company which is entitled to deduction under subsection 1 is transferred before the expiry of period of 10 years specified in subsection 1 to another Indian company in the scheme of demerger. So, scheme of demerger from an Indian company to Indian company, no deduction shall be admissible to the demerged company, and provisions applicable to the demerged company will continue to apply to the resulting company, assuming that demerger had not taken place. Subsection 8, where a deduction under this section is claimed and allowed for any assessment year in respect of any expenditure specified in subsection 2, the expenditure in respect of which deduction is so allowed, the expenditure on respect of which deduction is so allowed shall not qualify for deduction under any other provisions of the Act for the same or any other assessment year. So just to avoid double deduction, this provision has been inserted. So friends, section 35E is related to deduction incurred, is related to expenditure incurred on exploration, prospecting, production of mineral, and the same is allowed only to an Indian company or Indian resident, and it will be allowed in the ratio of 1/10 of the expenditure income starting from the year in which commercial production starts, and it will be allowed in succeeding 9 previous years thereafter. Amount of reduction allowed is 1/10 or amount of income whichever is less, and the period to be considered is the relevant previous year in which commercial production begins and immediately for preceding previous years. So friends, this was section 35E, was the last section under the subtopic other investment related, contribution related tax incentive scheme. Thank you.